Hello and welcome to our website. Today I will be discussing with everyone the 1031 exchange process and the various types of exchange strategies available to you as an investor. Before we begin, let me tell you a little bit about Asset Exchange Company. Asset Exchange Company was founded in 2006 by Leonard Spoto and Adam Skarsgård. Our headquarters is located in San Francisco, but we do have offices and affiliates in Walnut Creek, Irvine, and Arizona. As a qualified intermediary, we are required by the state of California to be insured and bonded. Adam, who serves as Asset Exchange Company's tax attorney, is a member of the Board Accountancy and State Bar. Many 1031 exchange companies offer similar services, but what sets us apart is our superior service. We are the only company in the industry that provides clients free audit support if the exchange is ever audited by the IRS. This gives investors like yourselves peace of mind because we stand by our services and strive to provide you with the best service possible. So when and how can an investor set up an exchange account? To start off, you will need to set up an exchange account with us before the close of escrow, not after. If you have already closed escrow, then it is too late to open an exchange account. You simply need to pay your capital gains tax. If you are in contract or in escrow, simply give us a call and provide us with your escrow's contact information, a copy of the contract, and a copy of the title report. Once we have all the documents we need, one of our exchange coordinators will prepare the 1031 exchange documents and coordinate with escrow to have them signed by all the appropriate parties. There are four types of exchanges available to an investor. The first type is the simultaneous exchange. When investors wish to close escrow on their relinquished property and replacement property on the same day, then they will use this exchange. This is typically rare because most of our investors will opt to use a delayed exchange instead. A delayed exchange allows an investor to sell their relinquished property, then purchase a replacement property within 180 days from the close of escrow. For an investor who would rather purchase first, and reverse exchange is a possibility. A reverse exchange allows an investor to acquire a replacement property first, then defer taxes on the relinquished property provided it is sold within 180 days. There are a few difficulties involved in doing a reverse exchange, but if you would like to proceed with one, please give us a call so we can discuss them with you. Lastly, we have the construction exchange, which allows an investor to use exchange funds to improve or build replacement property. There are four basic requirements when doing a 1031 exchange. These are number one, property qualification, number two, tax deferral requirements, number three, timeline, and number four, identification rules. In order to qualify for a 1031 exchange, your property must have been held for business or investment purposes for at least 1 year, but we recommend 2. The replacement property must also be like kind. This can be a source of confusion for many investors because they believe that they must acquire a replacement property of the same type that they have sold, such as a residential rental property for another residential rental property. That is actually not the case. A like-kind property can be any type of real estate. If you sell real estate in the United States, you can purchase any type of real estate in the United States. For example, you can sell a residential rental property and purchase land, sell land and purchase an apartment building, and so forth. Sometimes I get investors inquiring about foreign properties or quick flips. For foreign properties, you may not sell a property in the United States and exchange into real estate outside of the United States, and vice versa. For quick flips or even development projects, they usually do not qualify for a 1031 exchange because they are considered inventory. In order to defer 100% of your tax liability, you must reinvest all your cash and purchase a replacement property of equal or greater value. To determine the reinvestment requirement, we look at the net sales price of what was sold. To determine the net sales price, you take your sales price, then deduct the non-recurring closing costs. Non-recurring closing costs are expenses paid through escrow, such as commissions, escrow fees, recording fees, transfer tax, and 1031 exchange fees. But what if you have a loan on your property? Well, your reinvestment requirement in this example is still $900,000. When you sell a replacement property with a loan, you will need to pay back the loan when you sell the property. In this example, you may only end up with $400,000 in cash. In order to reinvest $900,000, you need to cover the difference with money out of pocket or get another loan. But what happens when you purchase a property of lower value? It does not disqualify your entire exchange. Rather, you would execute a partial exchange. In this example, if your net sales price is $900,000, but you purchase your replacement property for $800,000, then you would have $100,000 left over, or what we call taxable boot, which is taxable. The tax liability will include federal tax capital gains taxes, state tax capital gains taxes, federal depreciation recapture tax, and a federal tax to help fund Medicare. Everything added together is roughly 33%. So in this example, 33% of $100,000 is roughly $33,000. Please speak with your CPA for your exact capital gains tax because it can vary from individual to individual. The third requirement for a 1031 exchange is the timeline. From the close of escrow, you will have 180 days to close on your replacement property. But on day 45 of the 180 days, you will need to submit an ID letter to us identifying the potential replacement properties you wish to purchase. And there are two ways you can identify potential replacement properties. The first method is the 3-property rule, and the second is the 200% rule. The 3-property rule allows you to identify 3 properties of any value. Before day 45, you may submit as many offers for as many properties as you want, but by day 45, you must lock in on your top 3 choices and submit to us the ID letter. This does not mean that you have to be in contract or escrow on these properties. You simply need to identify them. But what happens if you are unable to acquire any of the replacement properties? Before day 45, you can change whatever's on your list, but after day 45, you may only try and purchase what is on that list. If you are unable to purchase any of them for any reason, then your exchange becomes invalid and you'll be subject to capital gains tax. The second method to identify potential replacement property is the 200% rule. The 200% rule allows you to identify any number of properties, but their combined value cannot exceed 2 times what you sold your property for. And so those are the 4 basic requirements to doing a 1031 exchange. In order to qualify, your property must have been used for business or investment purposes. In order to defer 100% of your tax liability, you must purchase a replacement property of equal or greater value to your net sales price. You have 180 days from the close of escrow to complete your 1031 exchange, and you must identify your potential replacement properties by day 45. Thank you everyone for listening in. I hope that information was helpful. If you have any additional questions or if you'd like to set up a 1031 exchange account, please give us a call and we are more than happy to help you with your 1031 exchange.